Well, I think if we have a look, as I said, Sydney and Melbourne have been very strong, and I'd expect that there's still got a bit of momentum in both of those markets. But I think outside of that, areas that offer good potential is Brisbane, because it's so much more affordable relative to Sydney and Melbourne. The same can be said for Adelaide as well, but economically, South Australia is not as strong. Unemployment's higher there, and it's probably not as strong or diversified as of an economy as a market like Queensland. And I think outside of Brisbane, some of the coastal markets close to capital cities, so areas like Wollongong and Newcastle, Geelong and these sort of areas, as people are priced out of the Sydney and Melbourne housing markets, they may look to move a little bit further out, whether it be as an owner-occupier or an investor, so making those markets more attractive. Well, if we look at the auction market, as you said, it's been very strong. We've seen clearance rates up around the mid 70% in Melbourne, and high 70s, low 80s in Sydney week to week recently. So auctions are very successful, but keep in mind it's only about 35% of the market goes to auction in Melbourne, about 25% in Sydney. So definitely there's other options. If you've got fairly standard stock in an established suburb, then there's not much point taking your property to auction. But certainly if you've got a unique property that's hard to replicate, auctions are probably the best bet. So I think you really need to consider what type of property you have, and then design your sales method around that property. So macro-prudential tools are designed in such a way to slow the level of lending in an economy. So in New Zealand, they've introduced these tools, and what they've done is limited the proportion of lending that banks can do to higher risk loans, which they've deemed to be over a loan-to-value ratio of 80% or more. In the UK, they've inserted limits on how much a person can borrow. So if you're on, if whatever you get on an annual basis, they may say you can only borrow 4.5 times your annual salary to invest or to purchase a home in the UK housing market. So essentially, what they are designed to do is slow down the level of lending. There's other things they can look at, like making banks hold more capital against mortgages, which would obviously maybe start to see banks preferencing other forms of lending as opposed to residential mortgages. I think they're very serious about it. I think they're definitely concerned about the level of investor activity taking place. A lot of investors buy inner city apartments. So with so much investment activity, you are creating risks in those inner city unit markets where investors are heavily focused. Because yields are very low, capital growth's been very strong, but obviously capital growth won't be strong forever. And if other markets like the share market pick up, for example, or once interest rates start to increase, people might want to go back into cash holdings. You could potentially see a lot of stock entering the market at a time when housing demand's falling.